My name is Mark Greenwood. I'm a junior at Utah State University studying finance. I will graduate in December of 2026. And yeah, this is our presentation and our team from Utah State.
Hi, I'm Colton Gunsler. I'm a master's student here at Utah State University. I'll be graduating in May with my master's in financial economics.
I'm Justin Fielding. I'm a senior at Utah State University studying finance, and I'll be graduating this December. To jump right in, we wanted to go over the historical financials that we were given for this competition. Um, didn't want to spend a whole lot of time on this, but just to highlight a couple things. We noticed that during COVID in the year 2020 and then following into 2021, um, our margins and our revenue decreased slightly. So our top line revenue was dropped to about 33 million. But since COVID, we've seen a strong recovery from in that revenue growth. Another thing we wanted to highlight is that our margins kind of followed our revenue. And in 2020 and 2021, we had a slight decrease in margins to then be recovered. And in the past few years, we've seen pretty consistent growth in the financial statements. Moving on to the balance sheet, we didn't want to point out a whole lot here. Just show that we condensed the balance sheet and made it usable for the business valuation case. On our liability side, however, we wanted to point to the total debt that we have in comparison to our total equity. So you can see our note payable line is fairly minimal compared to our total shareholders' equity, noting a high or low debt to equity percentage, which we'll talk about later in this presentation. We calculated various financial ratios to give us a good comparison for this company, a good idea where they're standing currently, and some context behind their operations. A few things we wanted to point out were the days receivable. Receivables have been decreasing over the last 5 years, which is important and is very positive feature for this company, highlighting that their efficiency in operations is increasing, that they're collecting their money faster and faster over the years, and that's a positive thing for this company. Closely tied to that, their days inventory have also been decreasing over the last few years. We also included an assets to business revenue ratio, which has grown over the last 4 years and shows us a good return on assets. There again is highlighted our total debt, which when compared to our total equity is fairly minimal, as well as our net working capital as a percentage of our revenue, which we wanted to highlight is about 21%. So shows us that we're a good operating company with decent margins.
Here we have the financial forecast. The 5-year projected forecasts were given to us by the company, as well as the spot numbers for 2023 and 2024, which we use to find our trailing 12 months. The trailing 12 months supports our projections going forward, showing that they have had a growth in the revenue from the previous year. We believe that these projections are both stable and reasonable compared to the company's historicals, as well as what we were able to find in the board minutes and information provided to us about the company. Just a couple quick metrics to note is they do have total operating expenses increasing slightly to 32.4%. And our net income as a percent of revenue stays stable at about 4.2%. Here we have the adjusted company balance sheet. Essentially, what we did here was we have the company's prepared balance sheet, and we adjusted for the adjusted book value, taking out different things like leasehold improvements, as it is more tied with the real estate, as well as the accumulated depreciation. In addition to this, the assets and different things, when looking at the adjusted book value, we decided that it was more, it would be better for us to take a 50% value to represent, as it would be more representative of the company. Here's the liability side of our adjusted balance sheet. Again, most of our adjustments were included in the adjusted book value, um, with things that we took out being the common stock, paid in capital, retained earnings, and net income loss.
So this brings us to our adjusted income statement, where what we have done is just presented the revenue and the pre-income tax profit for each of the historical periods since 2020, and then also the trailing 12 months. And then what we did with that is we added back depreciation to the cash flow, and we also added back interest, because those are both non-operating expenses. And then what we did in 2020 and 2021, where we made adjustments for the PPP loan income, as that provided income to the company that is not a part of typical business operations and will not be recurring moving forward. And then also the employee retention credit and the wages, FFCRA, were also expenses from the company that are considered one-time expenses, and not part of the company's typical operations. The information on these two items, the PPP loan income and those two expenses regarding retention credit and wages, were provided to us by the company management. We believe them to be accurate and agree with them being added back, which is why we have presented them here. The other thing that we have presented in this case is the historical rent that has been paid by the company. Typically, something that we are looking for is an adjustment to the fair market rent, as sometimes the company will be leasing it from the owner or from itself in different scenarios. But according to management and the information provided, they are leasing their space at a fair market value. So we did not see fit to make any further adjustments to the fair market rent. However, we did want to present it here, as that is typically something that we are going to be looking for. Beyond that, once we have our adjusted EBITDA and adjusted EBIT, we applied 100% weighting to the trailing 12 months. And this is because we believe the trailing 12 months to be the most accurate representation of the company's operating state moving forward. So that includes both their revenue and their expenses. And this gave us an adjusted EBITDA margin of 5.6%, which is slightly higher than some of the historical periods. And something that we looked at was both the forecast and the historical periods, the wages, especially in the forecast, were just a little bit higher, as labor markets continue to rise. So that's why we applied that 100% weighting the trailing 12 months. Then that gave us there at the bottom, you can see our weighted revenue of just over 60 million, our weighted EBITDA of just over 3 million, and our weighted EBIT of about 3 million. So yeah, this is our adjusted income sheet. And then this is our tax calculation. We took our earnings before interest and tax and then applied a state tax. As no information was provided for the state tax, we assumed that to be a 0% tax rate, leaving us with our taxable federal income of 3,085,000. And then the provided 21% federal income tax rate was then applied, giving us $648,000 in taxes, giving us our net income after tax of 2.4 million. So moving on to our company-specific risk premium, we analyzed a number of factors when determining our company-specific risk premium, including management, financial performance, customer and supplier concentration, competition, and both economic and industry conditions. As kind of just an overall kind of just note for this valuation and presentation, as this information was provided to us by management and we are then returning our information or evaluation to management, we did not see it fit to really go over much of the information provided, as we felt that would be just reiterating and regurgitating the information already provided to us, and that the company was well aware of the company's operations. So the first thing that we analyzed was the management or key person. According to the information provided by management, they have a good structure in place that if any levels of management or any people departed from the company, that just the other levels and other employees would be able to assume that role. So we did not see much management risk present. In terms of financial performance, like we talked about, they've shown strong growth in the last couple of years after that downturn in 2020 that we primarily believe to be related to COVID. And that is supported by our trailing 12 months as well. And then the projections also expect that performance to continue. Our adjusted EBITDA has remained strong throughout that period, with obviously the trailing 12 months kind of peaking at about 6%. Yeah, so we believe this strong revenue growth is going to continue, as we noted in the projections, and the profitability is strong. The customer concentration, the top four customers represent about 50% of the company's revenue in 2024, and they are recurring customers that we've seen over the last couple of years, so that does elevate their customer concentration risk. However, their suppliers are fairly spread out. Um, the company has several competitors uh, provided by the company and our own external research. However, the company does do some things to set itself apart, including using the in-house embroidery operations, but there is competition risk. Something important is the economic conditions. As we noted, the labor market is presents risk to the company is both um, just being able to hire employees, but then also wages are forecasted to increase. The company is expecting to spend more on wages, and we think that's a reasonable expectation. Something that's also been difficult at this point for the company has just been inflation, something that has been seen up to valuation date. So the economic conditions, as noted, are difficult for the company and present risk. The industry landscape, especially coming out of COVID, was a little shaky, but has rebounded well, and we feel is strong for both the manufacturing and also the retail selling of the equipment that the company sells. We feel that the industry landscape is strong. So based on all these factors, we determined that a company-specific risk premium of 5% was a reasonable um, risk premium for the company. We do see some risks in the company's operations. However, their strong growth and forecasted expansion, we believe, mitigates some of that risk. So we thought that we determined that 5% was reasonable. So that brings us to our build-up method. So the build-up method was determined using the risk-free rate, the equity risk premium, and the size premium. Um, and then also the added company-specific risk premium that was presented on the previous exhibit. And as Justin mentioned, the reason we used the build-up method here instead of a weighted average cost of capital is primarily just due to that debt that we observed the company having or not having. We did not see enough debt held by the company to expect moving forward that they will continue to hold a lot of debt. And for this, we determined that using the build-up method was a better discount rate than the weighted average cost of capital. So these rates were selected on March 1st, 2024 to represent the valuation date and gave us a cost of capital of 20.7%, and that is rounded to two decimal places. So that then brings us to our net cash flow. So we pulled our earnings before interest and tax, um, subtracted our corporate taxes as presented previously, added back our depreciation, and then subtracted both capital expenditures and increase in working capital. So our capital expenditures in the historical periods represent the change in net fixed assets for 2020 through 2023. And we felt this was a good proxy for the company's fixed asset expenses moving forward. In the trailing 12 months, um, the 362,000 of capital expenditures we felt was a good expectation, as the company is currently in the middle of a website project where they're spending additional capital. And using those last two periods, we see an increase in our capital expenditures. But we do not expect it to be as high as the 645,000 or the 562,000 in 2022 and 2023. And so for that reason, it's a little bit lower. However, we do believe it will be higher than the 2021 and 2020 periods. The increase in working capital was taken using that 21% of working capital, as Justin mentioned. This has been what the company has operated at in the last two full year periods. And we feel that for this industry and this company, 21% of revenue is a good working capital number. So the 366,000 was then grown by our long-term growth rate of 3%. And our change in working capital was then calculated based on the next forecasted period and our trailing 12 months. And that gave us an increase of working capital of 366,000. So with those, that gave us our free cash flow in the weighted trailing 12 months of just over 2 million that we then grew by 3% to give us our projected net cash flow. And then using that projected net cash flow, we have our capitalization of cash flow with our cost of capital as we previously presented of 20.7%, and then our long-term growth rate, as we mentioned, of 3%. And we feel this is reasonable for a long-term growth rate. And this is supported by the company's projections that are a little bit higher than that in the near term, but we believe 3% for a long-term growth rate is accurate. That gave us a capitalization rate of 17.7%, giving us a value of invested capital as a liquid controlling portion of 11.6 million. And then we applied a discount of lack of marketability of 10%. And we feel that this is a good expectation for a discount of lack of marketability because the company is larger than a lot of your typical small, closely held businesses. However, the nature of the company of being a private company does present challenges to selling the company on the open market, both in terms of a partial share and a full share. And we determined that 10% was reasonable for the company for a discount of lack of marketability. And that gave us our best value of invested capital as an illiquid controlling portion of $10.5 million.
Our discounted cash flow analysis. We took the company's EBIT from their projections. As has been noted, the company going forward was projecting revenue growth at 8%, and 5% in the years going forward, resulting in an EBIT growth similar to that. We do feel like this is reasonable considering their past historical growth. Here we took the EBIT, we subtracted out the corporate taxes, added back depreciation, and took out the change in net working capital and our capital expenditures. Our change in net working capital was derived using the same calculation as was mentioned before on our net cash flow to invested capital. And if you look at the numbers, they are the same. Our capital expenditures here, for the first 2 years going forward, we felt it was prudent to take the trailing 12 months and maintain that as they're finishing up their website redevelopment. However, we do believe that once they finish that website redevelopment, their capital expenditures will decline and become closer to those historical averages that we had seen previously. And we represent that from going from 362K in capital expenditures down to about 181. That gave us our net free cash flow. We took the present value of these cash flows as well as a terminal value using the Gordon growth method, using the same discount rates as we did in the capitalization of earnings with the 20.7% cost of equity and the 3% long-term growth rate. This gave us a total net present value of the company of 14.3 million. We took the same discount for lack of marketability for the same reasons as the capitalization of earnings. And after that discount, that leaves us with a present value of 12.8 million.
A different approach. We studied the market data available to us to derive another value for this company. Looking here at our market approach data, we really focused in on B2B businesses that match operating styles and a business plan, similar to the company that we were valuing. We felt this was very important as to place heavier weight on the operation side than other variables, say the net sales, or the sheer size of the company, seeing as how operating businesses that are similar tend to perform similar. So going across here, we've included a few things in our market comp selection, such as net sales, um, ranging from a couple 100,000 up to a couple million, 6 million, I think, being highest. And then coming across, we see our sell price to net sales, and then our sell price to EBITDA multiples with similar operating profit margins, giving us context of where our company fits compared to available comps. And then we really focused on the EBITDA margin. So based on our EBITDA margin of 5.6%, putting us on the very low end of this set of comparable companies, kind of gave us reason to weight the EBITDA multiples that we use to value this company on the lower end. So our 10th percentile price to EBITDA multiple was 2.38, and that's about the multiple that we chose to value this portion of the company. And you can see we included the revenue multiple as well, mostly for context. We wanted to see where the two lined up. However, for an operating company of this scale, with the historicals that it has and being a well-established company, we felt it appropriate to weight the EBITDA multiple at 100%, basing our valuation on that as is market standard. So that gave us weighting it choosing a 10th percentile multiple to value our company gave us an implied value of about 9 million.
That analysis done with both our income market, our income market and asset approaches. We have our conclusion of value. We did determine that it would be important to present each of the methods that we've presented previously, including the capitalization of earnings and the adjusted book value method. However, we did determine that it was most appropriate to weight only the discounted cash flow method and the private company transaction method within our income and market approaches. That gave us a concluded value of our discounted cash flow as previously presented, weighted at a 50%, and then our private company transaction method, as Justin just went over, at 50%. And so that gave us an applied value of about 6 million and 4.5 million for those, giving us a fair market value, the 100% interest of 10.9 million, and that is rounded. And then as we were valuing just the 51% share of the company, we then applied that 51% interest to our fair market value, and that gave us a fair market value of 51% interest non-marketable but controlling interest. And we determined that to be controlling as it is a 51% interest, and we could not find any information on specific voting rights or things that would lead us to believe that a 51% share would not be adequate to be a controlling interest. So we made the assumption and determined that the 51% share would be a controlling interest, and because of that also did not apply a discount for lack of control. So that 51% interest, non-marketable controlling interest, we determined to be $5.5 million, 5,591,000, and again, that is also rounded. So that is our conclusion of value that we determined used on the previous approaches, and we feel that this is an accurate and reasonable valuation of the company, both at 100% interest and 51% interest.